Hello, everybody. Welcome to another episode of Simply Bitcoin IRL. Today's guest is Lyn Alden. Before I bring her on stage, I want to give a shout out to the awesome Bitcoin company that powers the show. Swan Bitcoin, best place to stack sats. They incentivize dollar cost averaging and self custody. You buy any size of Bitcoin from $10 to $10 million. What are you waiting for? Visit swanbitcoin.com today. Anyways, Lyn, thank you so much for joining us today.
Happy to. Thanks for having me.
So, purely by chance, you came on the show a day or two after the Fed had a 15-year record of rising interest rates. What was your perspective? What was your perspective on that?
Well, so far that was in line with expectations. So the markets were expecting the rate hike that they got. It's slower than some of these prior rate hikes, but it's still faster than what has been common in modern times, this kind of current regime that they've been in. And what surprised markets a little bit was that the dot plot was more hawkish. And so basically the Fed raised in line with expectations, but also was a little bit more hawkish in terms of the future, in terms of how high or how long they plan on keeping those rates. Now, something to keep in mind is that the Fed dot plot has not historically been very accurate. If anyone looks at the dot plot and then trades based on it, I wouldn't do that necessarily. But that doesn't mean that when that kind of thing happens, it still shows what their intentions are, and so that can spook the market. And sometimes those market spooking events are what eventually contribute to the dot plot changing, right? So the fact that if markets are so strong, that gives the Fed more ammo to keep tightening. Whereas if you do start to see more problems in the market and the economy in general, that can slow down overall Fed actions. But basically, the summary of yesterday was they raised in line with expectations, but were a little bit more hawkish about the future than anticipated.
So, and what are your expectations for 2023, right? Because the whole, what you're hearing over and over again, and I was, fortunate enough to have Nick Badia on yesterday, and I asked some very similar questions, and I'm comparing what you guys are saying. And what are your expectations for 2023, specifically for how Bitcoin will perform? And the reason I ask that is because Bitcoin has never existed in a recessionary environment. Is it going to continue to act like a risk on asset?
I think most likely, but I would put some caveats on that. So, in this year, for example, we've seen an economic slowdown, but not a recession necessarily. And a lot of the downside we've seen in most assets is about valuation compression, right? So if you say, for example, invest in a stock, right, and you're determining what is the right price to earnings ratio to pay for the stock, obviously it's going to depend on growth rates, it's going to depend on the company safety, all sorts of different reasons. But one of the factors you take into account is what could you get with another investment, right? And the most common one it's compared to is the 10-year treasury yield. So if you can put your money into a 10-year treasury and get a 5% annualized rate of return, then you'd maybe expect, I don't know, 12% return from equities. So a 7% premium in order to, take on the added volatility risk and risk of loss that you'd get from an equity, at least in the modern system as currently constructed. On the other hand, if treasuries are yielding 0.5%, so practically nothing, then you might say, well, I mean, if equities can return 7%, I'll take that. Um, and so you'll pay a higher multiple for the same expected stream of cash flow. So all the company details are the same, but you're willing to pay more for it because you're comparing it to the range of possible, traditional asset alternatives. And so as the Fed has raised rates, they raise the short end, but it trickles out into the long end, and so do things like inflation expectations and economic performance expectations and things like that. But when those rates, short and long, move up across the board, that reduces the fair value to pay for equities. And then also to some extent impacts things like gold or Bitcoin, because you basically have a hardening of the dollar, at least in a relative sense, compared to other currencies and compared to what's been happening. So we've not had fast money supply growth this year. We're actually kind of flat to down for the year, which is unusual compared to the prior 2 years of rapid money supply growth. And so that puts a lot of pressure on all assets kind of equally. So bonds are down, stocks are down, kind of harder assets in general are down. And obviously, if you have leverage attached to them, you can be down more, which is kind of what we've seen in the Bitcoin crypto whole space, this whole kind of rehypothecation blowing up. Um, when we look at the 2023, I see something a little different, which is, we're getting probably close to the top of the Fed hiking cycle. And so I'm not as concerned about valuation compression going forward, at least after maybe quarter one 2023 or so. But I am concerned about corporate earnings going down because I think the economic deterioration is likely to continue. And so I think you could see better results out of things that don't have earnings. Things like gold or Bitcoin that don't have earnings, they're not valued based on their earnings. They're monetary assets. Whereas I think you could still see some weakness out of equities. And so I think you could see more differentiation next year. But I try to avoid giving 1 year price predictions for an asset that's so volatile because it's like part of answering that question is, well, what happens to Genesis? What happens to Grayscale? What happens is Binance fine? I think so, but maybe not. I don't know. And so it kind of you have to answer industry specific questions, often with opaque balance sheets and human decisions and things like that. But I think that historically, if you look at it, Bitcoin generally does well in rising PMI environments, so economic acceleration generally does flat to down in falling PMI environments, so economic deceleration. And it usually historically tends to bottom before PMI bottoms. And I think, because liquidity tends to bottom before PMI bottoms. So actually, probably the closest overall correlation to Bitcoin price has historically been liquidity. And I think we're seeing maybe signs of that bottoming perhaps in the the first half of 2023. But that's kind of just where we are right now. I mean, things can change in a month based on new information coming out.
So you mentioned that you believe it 20, you believe that 2023 could potentially be the end of the Fed hiking cycle. But isn't that dependent on the inflation numbers? Do you believe that we've already peaked inflation, and is it coming down? And also, to add on top of that, right, you're starting to see articles by the legacy mainstream media. There was an article by the Wall Street Journal, and trying to attempt to normalize, the way that they advertise is like, we don't really need 2%, we need 4% inflation. So do you think that if they do get it down to 4%, that's good enough for them? They'll start trying to normalize that moving forward. And the first part of the question was, is the end of the Fed hiking cycle dependent on if inflation is in fact under control?
So yeah, a couple different questions there. I'll try to go through them. One is that I do think we're at the top of a local peak in inflation. The way I've been framing it, and this is before inflation rolled over, is that I think that just like the 70s and just like the 40s, that this is going to be an inflationary decade, but that doesn't mean you just constantly go straight up. You often have periods of disinflation, cyclical disinflation within a structural inflationary environment. And so usually it's because there's attempts at counterattacks, right? It could be Fed tightening, it could be price and wage controls. There's basically various kind of pushbacks that these top-down planners can kind of do against those forces that work for a period of time until something breaks and they have to change course. And so, I it actually, if anything, came about a quarter later than expected, because starting at the end of 2021, I was predicting that around quarter two would probably be the peak in inflation. I think the Russian war added like a quarter to that. It kind of stirred things up a little bit more than otherwise would have been, and so we got the peak in quarter three, and now we're rolling over. And I think as long as, it kind of comes down to how quickly China reopens. If they just tomorrow say, "Hey, we're going to go all out. We're going to completely reopen. We're going to give everyone, $1,000. We're going to promote like flights and travel and other fuel intensive things." You could get a major breakout in oil, for example. And that's obviously an extreme example that just shows how, some decisions can influence this. But essentially, I do think we're in a disinflationary environment. At least in the maybe first half of this year. I mean, next year, like 2023, maybe throughout the whole year. Where I would get concerned about another wave of inflation is maybe 2024, 2025. Next time when we kind of enter like another growth period, and that kind of goes back to the Fed. I do think if you got an inflation drop down to say 4%, I think you'd have more questions among Fed officials. I think some of the more dovish ones would be in favor of kind of loosening policy, especially if economic growth isn't very good or is an outright recession. Some of the hawks might still stick to it, though, because, for example, it seems to be the case that Powell has tied his legacy to his ability to get inflation back down. And so I think that he might be stickier than some of the others. But I certainly think that as it gets lower, that raises some questions. But it really comes down to what else is happening, right? So 4% inflation, if the economy is very strong, they can still justify raising rates more. On the other hand, if it's 4% inflation, but they're in a unmistakable recession, and they have Congress breathing down their neck, and just rising problems, or if they have some sort of problem in the treasury market, due to illiquidity, then that's a different discussion. Then they might have to do some sort of a different approach, and kind of reinject liquidity into the market, despite the fact that inflation is above their target. I think that the overall end game, kind of later in this decade, is that they are going to be forced into a corner where there's inflation, and they're stuck adding liquidity to it. Basically to finance kind of, to monetize government deficits. So it could be in the form of yield curve control, deficit monetization, kind of, another round of QE, kind of like what we saw, I think, as a microcosm of what happened in the UK. So they had 10% inflation. They were talking about reducing their balance sheet. And then they had this awkward period for a few weeks where they had to, buy gilts. They had to buy UK sovereign bonds to bail out their pension system. And I think you could see rounds of that in the US. Maybe not right away, but I think that that will be something that happens, here in the 2020s.
So you said something interesting, which was the that I'm literally miss. Oh, there. I literally highlighted it. Highlighted it. Inflationary decade. You believe that's going to be an inflationary decade? Last time that happened in the 1970s, the stock market was relatively flat as well. Do you believe that is going to happen? And are we? Does this mean we're finally going to see a decoupling? Are we going to finally see a decoupling from traditional assets? Right, because Bitcoin has been highly correlated so far.
So both in the 40s and the 70s, you had commodities do better than equities. Equities were kind of range bound, as you pointed out. In the 70s, in large part, that was because, if you had interest rates that are double digits, that goes back to my prior point where what is the fair value of an equity? If you can get 10% on treasuries, you probably have to price the equity in such a way that you can get 15% or more returns, which means paying a very low multiple. And so you basically had, nominal growth from inflation of earnings and things like that, but then it was offset by valuation reductions. And so you got this big flat, choppy pattern. In the 40s, it was different because, due to how high debt was, government debt, the Federal Reserve did yield curve control. So they kept interest rates low despite the fact that inflation was high, and yet you still had equities be very range bound. Now, obviously, there's other factors. Investors had to price in like the probability of winning or losing the war, for example, and the market basically bottomed as soon as the United States started making major victories, like after the Battle of Midway, for example, when it really kind of turned the tide on Japan. And so there are other factors that always make these things complicated. But overall, if you have an environment with negative real yields, equities can still probably do okay. Whereas if you have high nominal yields and high real yield, that puts a lot of downward pressure on equities. So overall, my expectation is generally that we won't see great performance out of equities over the next decade. I think that the prior decade was this big gain. It was very disinflationary, which was very good for corporate profit margins. But I think now they're going to have higher structural wage pressures in many cases, and I think that's going to just challenge overall profit margins, and they're likely to face some degree of just valuation compression and kind of trend sideways, at least in real terms, right? So I mean, if inflation's bad enough, like if you look at an emerging market equity index, they'll generally be doing great in nominal terms, local currency terms, but they'll be doing sideways to down in dollar terms. And so I think you could see something like that in the U.S. where if you do kind of by the end of the decade have runaway inflation and some sort of Fed repression and yield curve control, you could get a nominal breakout in equities. But it wouldn't necessarily be a good breakout in real terms. So I think my higher conviction case is a long period of sideways chop, at least in real terms, and probably for a number of years in nominal terms as well.
Interesting.
And as for decoupling, yeah, I think so. Basically, inflationary decades are very good for commodities, basically things that are scarce, they don't have margins. So gold, oil, copper, silver, Bitcoin, things like that. Bitcoin, the challenge there is that it's still perceived as a risk-on asset in large part because it's just not well understood. It's not widely held, and it's often leveraged because of its upside potential, and so that creates downward explosions. Um, so I think it'll still probably be correlated to say the PMI cycle for quite a while, meaning it's generally going to do better in risk on conditions and worse in risk off conditions. Um, but I do think that it can, if equities go sideways for that decade, I do think that Bitcoin can keep grinding higher, even if it's still often correlated on a day to day basis, more often than not.
Interesting, interesting. So, Lynn, one of the reasons that I invited you on the show is we had this amazing conversation at Pacific Bitcoin, and I really found it interesting. And it was actually one of the tweets, one of the tweets from a long time ago that made you ask this question, made me ask you this question. Basically, the tweet said something along these lines. I'm paraphrasing here. It says Bitcoin's peer-to-peer transactions will make it harder for governments to tax individuals, and that might force to revamp the tax and collecting mechanism altogether. And it makes complete sense, right? And what would that new mechanism look like? And another component, and to kind of tie this in with the recent bill introduced by Senator Warren and Senator Marshall, which I don't think it has enough votes to pass, but in that bill, right, the justification for that bill is, to stop money laundering, etc. So how does that play out? I feel like it's going to cause a lot of commotion.
Well, okay, so the bill question and then the other. So the first question was kind of a long range approach. Like let's say we make multiple assumptions. Bitcoin's very successful. Bitcoin becomes very widespread. Bitcoin becomes more private due to various layers and things like that that can do that. Then that presents a challenge to the government because it makes it harder to generate income from seniorage, and it also makes trouble, determining what people's income is or what their wealth is and things like that. And you kind of have to go back to, the 1800s or earlier, that kind of era, to see how they handled that kind of situation. Because a lot of transactions were just private bearer asset transactions. You give someone a silver coin, you get your bread, right? Or even if you're just handling banknotes that are redeemable for those metals, and so that creates a problem, and that's why you didn't really see a lot of income taxes formalized back then. It's just the administrative overhead was complex, and the ability to hide things was very easy. And so instead you would put taxes on. You always had to put taxes on things that you have a very high degree of transparency into. And so that'd be things like property, right? Property is very transparent, physical property. You could also, tax big things at the point of entry. So, import taxes, export taxes. You can also tax retail establishments, basically businesses, that have a presence and um, they have formal accounting, and so it's easy to look into their books. You can tax certain things that like alcohol or tobacco or things like that. And so that's how governments used to get a lot of their tax revenue. But in this era of fiat banking and more transparency of incomes, you've had, now in most countries, the income tax is often the biggest line item where they get, and especially when you add income tax with, say, payroll taxes, all the different types of income taxes together that are tied to income. Usually it's the vast majority of taxation. And it is harder to maintain that if you had overall better privacy as a widespread usage. But I think that's something that we don't see this decade. I think that's something that if you look at the long arc of time, that's something that we have to consider. With the rise of just encryption and money, right? So if you have Bitcoin, and then especially if you have Lightning or just various ways to make that naturally more transparent, and if those are widely done, it just changes how the government has to get revenue just out of necessity. Um, and then, as for this bill, I mean, right now it is clear that governments don't like privacy. Um, they usually wrap it in terms of either drug trade or terrorist financing, and of course, on the margins, those are problems that law enforcement should be looking into. But the problem is where they say, okay, because these things exist in the margins, nobody's entitled to privacy anymore. That's where they would get pushback, and that's where there's these debates where some people will say we have to stamp out 100% of XYZ, and therefore all citizens have to give up certain rights of expectation around privacy. Obviously, I would take a different approach. I would agree with the other side that says no, no, like go after people that commit a crime, but we're not going to go back and claw back privacy and rights for all people to catch the 1% of people that are using that privacy in a very deleterious way. And so I do think that's going to be a big battleground kind of for the foreseeable future, for the next decade or so, right? So, I mean, most governments are not threatened by you holding Bitcoin in some sort of custodial environment that they can easily just, control and surveil. But the idea of self-custodying money using privacy techniques and moving it around, that threatens their revenue model. And then, they'll often phrase it as terrorist concerns and drug concerns and things like that, which I think some of them are, say legitimately concerned about. But I think that overall it just kind of threatens their general ability for seniorage and transparent taxation.
And let's talk about that, right? The seniorage aspect, right? And we know that how it currently works, right? That governments get away with this tremendous amount of deficit spending. If if enough a portion of the population opts out into Bitcoin, adopts a Bitcoin standard, will they be able to maintain that privilege, keep that privilege, being able to print money for free for themselves that everybody else has to work for? Or does that change? People adopting a Bitcoin standard, does that affect their ability to do that?
Well, so again, if you had extremely widespread usage of it, then yes, I think that would reduce it. Essentially, what I'd argue is that in addition to shrinking parts of it, it would make it more honest.
But
Essentially,
hold on, Lynn. Sorry to interrupt you. I need to understand, and I want my viewers to understand as well. How would it reduce it? How would enough usage of Bitcoin, enough individuals adopting Bitcoin, how would it reduce their ability to do that?
essentially by forcing them to be more transparent. And I'll explain why. So, for example, if everybody holds cash, and the government runs a deficit, which most governments do most years, they run some degree of a deficit. And what happens is they essentially print the difference, or they have their central bank print the difference. And so what they're doing is they're contributing to the growth of money supply in the broad sense. In addition to bank lending being a big driver of overall nominal money supply growth. And what that does is it says, okay, everybody's paying, XYZ tax. Like let's say everybody's paying a 20% income tax. Here's the government revenue, here's the government expenses. Uh, the government's expenses exceed that. And so instead, you're paying a hidden tax because your cash holdings are getting diluted, and most people are not. They might vaguely be aware of it, but they don't know how to measure that necessarily. Like, what does that mean? What is the equivalent tax rate of that level of inflation happening? And not just inflation relative to zero, but inflation relative to deflation, right? Because if you had like back in the 1800s, United States, for example, deflation was the norm, which you'd expect to be the case. Kind of like how in modern terms TVs get cheaper most years. Phones get either stay the same or get cheaper, but either way they're getting cheaper per unit of quality, right? So even if $1,000 TV today is the equivalent of like a $10,000 TV from like 5-10 years ago. And if you get like a kind of almost like an apples to apples TV, it's way cheaper today. That's technology deflation in many cases. Same thing like if you measure the price of wheat in gold, it's generally trended down over the past century because we have better technology for, say, harvesting wheat. Whether it's healthy is another matter, but we can get more calories out of the ground per a gold equivalent because we have better technology to do it. And so actually the baseline we should be measuring inflation from is generally some low negative number, which changes based on productivity growth over time. And so your savings should be going up by maybe 1 or 2% per year in terms of their buying power on average, roughly speaking. But instead, if they're going down by 5% or 7% a year, for buying high quality scarce goods like high quality real estate and things like that, then you're essentially being diluted in a way that's hard for you to measure. And the other side of that dilution is the government. And the way that I framed it before is that, in a more honest system, it, to some extent, it would mean a smaller government, but it would also mean a more transparent government in the sense that to the extent that they want to pay for something, they have to tax something. Like, let's say the United States wanted to invade Iraq, like they did 20 years ago. And you poll people and you say, should we do it? And everyone's like, yeah, go get them. And they say, okay, well, we're gonna have to do a 5% income war tax. Are you still in favor of it? Well, suddenly, like, some percentage of those hands are going to go down, right? People are like, "I have to pay for this?" No. But it's like, of course we had to pay for it. Someone had to pay for it. It wasn't free, and it was paid through higher debt and currency dilution. And so in a harder money environment where people are taking their, if enough people take their money out of banks and out of that currency in general, out of, assets denominated in that currency, whether it's banks, whether it's T-bills, things like that, and if they're hoarding Bitcoin or gold or whatever the case may be, or if we're talking about another country and they're instead hoarding dollars, for example, they're not holding their, I don't know, Indian rupees, and they're instead holding dollars, whatever they're not holding, that's basically, it allows that currency to depreciate faster, which kind of pressures the government ability to kind of keep printing at the rate they have been. And so that's kind of how that plays out long term, in the sense that if this network is successful and if it's more widely held and if people generally prefer that over holding cash, it does constrain government's ability to do things, that specifically things that are not popular among the public. So if something's still popular, let's say you have a country like Sweden and they want, certain types of healthcare, right? And say 80% of them want it, the government can still do that because they say, okay, everyone's going to pay this tax and everyone's going to get this benefit. And if Swedes are happy with that, then it works. The things that don't work are things that when you poll people and say, would you pay a tax for this? If they have trouble comfortably getting over and maintaining 50%, those are the types of programs in that country that are unlikely to survive in that kind of harder money, more transparent, honest environment.
Understood. So one of the things, Linda, I want to ask you, you said if the network is successful, what things keep you up at night? What are the things about Bitcoin? What are the things about the Bitcoin network that potentially worry you? Is it a failure of a potential, introduction? I mean, that'd be so hard to do with how, the nodes are really the decentralization of it. But what are the things that maybe we don't foresee? Do you think it's a nation state attack? Um, do you think it's the centralization of miners? Because you did say if the network is successful.
I try not to think of in terms of inevitabilities because I think that leads to complacency. Um, and so I always frame things in terms of risk. So the risks that I've outlined before, and I can share here, essentially are: one would be some sort of bug introduced to the code that causes a problem. Now that's not necessarily unrecoverable. It's happened in the past, and there've been bugs before that have not been exploited. Like they were kind of fixed, and then it became more understood that they existed. And so, but they can lead to unintended chain splits. They can lead to loss in confidence in the kind of the immutability of the protocol if they were to be big enough and catastrophic enough and hard enough to fix. Basically, if enough nodes upgrade to something, kind of the whole point of running a node is that you're self-sovereign. But of course, most people don't comb through every line of code
Mm-hmm.
and confirm there's no bugs. Even if you're a professional, you can still miss. Even the professionals who do that for a living can miss issues. And so if they're then forced to update to something to fix a critical bug, they're essentially kind of losing some degree of their self-sovereignty. So I think that the instance, kind of the severity and frequency of bugs can be a problem, or some sort of degradation that happens over time. If there's kind of like you know um, problems with updates that are discovered like years later that it's kind of already soaked into the network. Those I think are something to kind of keep in mind for a tail risk. Um, Minor centralization is I think a partial risk, right? It's something I would like to see more and more decentralization of mining. I'd prefer not to see over one country or one kind of alliance of countries have over 50% of hash rate. Um, but that's at least a recoverable risk, right? So if the network does get censored, then there should be fee incentives to entice miners to spin up in other jurisdictions to kind of uncensor that network. And so I think over time, that's not a risk I'm super concerned about, unless the Bitcoin network just kind of stagnates in terms of users and transaction volumes, which is not my base case. I think another risk is if the United States were to ban banks from connecting to crypto exchanges or Bitcoin brokers or just all the different fiat on ramps, if they were to be shut off the United States and other kind of Western nations, kind of like what say Nigeria has done, um, I think that's again it's a survivable thing, but that'd be like a nuclear winter for I think price for a period of time because inflows become instead of a flood of inflows, you can get a trickle of inflows through kind of peer-to-peer methods like again they use in Nigeria. Um, the the caveat with that is that if they were to do that, then probably something really bad's happening, right? I mean, it's almost like a signal that if they don't want you to own it, you probably should own it. Most of the countries that end up banning Bitcoin or reducing their bank's ability to kind of let you flow into Bitcoin brokers or crypto exchanges and kind of freely trade, usually it's because their currency is not very strong. Um, and so those are the major kind of risks I think about, essentially bugs, some degree of mining centralization, which can include supply chain centralization. I want to see more diversification in terms of the production of miners as well as the operators of miners. And I do think we still have a window here of nation state attacks that can at least make the lives of Bitcoiners a lot more difficult and damage the fiat price for a long period of time. Because part of what makes Bitcoin attractive is that it goes up, even if it doesn't go up every year, it does grind up over time. And the longer you have periods of stagnant price, the more people can lose interest, and that can very much slow down adoption.
Yeah. And what you said about Nigeria is fascinating. And the Nigeria case is really interesting to me, Lynn, because, you had this infamous report by the United Nations basically making the case we must stop Bitcoin adoption in developing countries. It's a threat to monetary sovereignty. They suggested central bank digital currencies, of which Nigeria launched. It's called the e-naira. The adoption of the e-naira, though, is like 0.5% of the population. Compare that to Bitcoin and other cryptocurrencies. It's up to, I think it was up last metric I saw, it's up to 35% of the youth population, even after the crackdowns. And then why that happened? The reason is because a central bank digital currency doesn't solve the reason as to why people are opting out in the first place, which is inflation and censorship. So and it's interesting because you see this in the countries that are trying to stem the flow the most, which is countries with high inflation. Governments don't want their citizens, running out, whether that's Lebanon, Turkey, Argentina. But people still kind of find a way out of necessity. What worries me is that in the West, that incentive isn't there. People are complacent. People are very happy with the financial rails. But I do see that incentive in developing countries, and that makes me at least more optimistic about the adoption of Bitcoin happening on a much quicker pace.
Yeah, I think global adoption is where it comes from for the most part. I think that's the optimistic take, right? That basically the way I would phrase it is that there's 180 currencies. There probably shouldn't be. I mean, that's almost a barter system. I mean, I think that's evidence of how bad the current financial system is. The fact that you have these kind of 180 different local monopolies. The vast majority of those currencies are not saleable outside of their legally enforced monopoly. I mean, in the desk drawer next to me, I have some Egyptian pounds, I have some Norwegian kroner. Even though the kroner is a pretty strong currency, if I try to use it around here, yeah, there you go, it's not accepted, right? It's actually really hard to get rid of it. And other than the dollar, maybe the euro, the Swiss franc, a couple others, it's just there's not that many saleable monies. And the way that I've described that before is that for thousands of years, commerce and money moved at the same speed, which was foot, horses, ships, things like that. Even when you had banking systems, those banknotes and those ledgers could only move again at the speed of people, at the speed that people could move, right? But once we invented telecommunication systems in the 1800s and laid those undersea cables in the second half of the 1800s, we now could update global ledgers around the world, and but we can't move the base, we can't move gold that quickly, right? And so that necessitated abstraction, centralization, and allowed all this financialization and games to occur. And gold was never, kind of good enough to be a alternative because it can't move around that quickly without abstracting it. And when you can abstract it, then it gives the abstractor the ability to sever that peg, basically to drop that abstraction. And so with Satoshi's invention, for the first time since the invention of telecommunication systems in the 1800s, it reinvented it basically added up the speed of commerce and the speed of money again, right? So we're kind of back in the environment where they move at the same speed. It's just that money caught up to the speed of commerce. And so I think it's going to take time to explore what that means. But one of the things it means is that there's really no longer a reason to have 180 different little local monopoly currencies. Back in the gold era, gold, silver were money, right? And it's like not like these countries had their own completely free floating monies. They might have stamped the money differently. Sometimes there'd be banking and kind of representations of money, but essentially you had a handful of different global monies, or at least all of the fairly advanced civilizations. And we've kind of degraded from that in a way, just because of the order that technology develops. I mean, there's kind of no other way that it can develop. I mean, telecommunication systems are going to happen before something like Bitcoin happens. If you survey 100 alien civilizations, they're going to get telecommunications before they get this like immutable blockchain. It's kind of just path dependence. And so there's going to be this awkward period where, signals and commerce can move faster than money. But now they're trying to fight back. So these local monopolies, they've grown accustomed to this century and a half of having this environment that kind of affords governments the ability to be the sole issue of money. And now that there's an alternative, it just kind of it's a challenge, right? It's like if you're a horse, if you're in the horse industry and then someone invents the automobile, that's a challenge. And if you're in the business of trying to, you're a government and you're kind of uniquely capable of solving that mismatch, you're able to get the monopoly on money issuance. And now there's a way that doesn't need you. That money can now move as fast as commerce, and kind of over time takes away your seniorage or threatens it, starting with the periphery currency, starting with the weakest currencies, the smallest
Mm.
currencies. It doesn't start with the dollar or the pound or the euro or the yen. It starts with the currency you can't even pronounce, right? It starts with one of those and threatens that one, and then it kind of moves up the chain. And so it's natural that governments are trying to push back. They're saying, okay, here's a central bank digital currency. We're going to restrict cash. We're going to do X, Y, Z. But I view it as kind of a flailing defense of something that its time has, I would say, come to pass. Now, in this early period, Bitcoin's still super volatile, so there still is a use case for things like dollars and dollar stable coins and things like that. But if you do get to a point where Bitcoin is 10 times bigger, 20 times bigger, less volatile, more widely held, more ossified and understood among the general world, that increasingly, it's like who would want to not hold that and instead want to hold some local, less saleable, you know, monopoly money, essentially.
And I completely agree. And their last gasp is the central bank digital currencies, right? And the way that I see it is they really have coercion. That's all they have. They can't match Bitcoin's incentives, but you can't. Doesn't mean they're not going to try. Lawrence Lepard calls it privilege. You call it seniorage. But yeah, they want to hold on to that special ability. Let me ask you something, because you said something really interesting about how, if alien civilizations, they're going to find they're going to they're going to discover things first. Do you believe that Bitcoin was discovered or invented?
So I think digital scarcity was a discovery.
Mm.
I think basically using this type of technology is a discovery. Like if you surveyed 100 alien civilizations, they'd all eventually discover electricity if they get to a far enough stage. They might not get to that stage, but if they do get advanced enough, they will eventually discover electricity. It could be different ways and slightly different orders, but they'll get there. And I think that you know, the idea of digital scarcity is a discovery. Once you have a you know global or national network of computers and basically all this fast moving information, there's now a way to have digital scarcity. I think that would be rediscovered in multiple contexts. The part that's an invention is that things that could have been different, right? So it didn't have to be 21 million Bitcoin. It could have been 42 million Bitcoin, right? It could be block times could have been 15 minutes or 7 minutes instead of 10 minutes. Um, the initial block size limit could have been a half a megabyte. It could have been 4 megabytes. I think he picked his variables very carefully, but you can imagine the chance that another alien civilization has that they get here and they also pick 21 million as their cap, and they also have 1 megabyte block sizes. That's the part that is an invention. That's the part that could be different. So I would say that Bitcoin is both a discovery and an invention because he discovered the core thing that makes it work, and then he implemented it in the form of an invention.
And that discovery could only be made once, right? Because every iteration, every copy of Bitcoin after the fact was made after it was already discovered that this type of technology could potentially have value. Therefore, it's tainted, right? That Bitcoin had this virgin birth, so to speak. Do you believe that?
For the most part, I think because once it's discovered, I mean, part of why it got so widely distributed is because people didn't know it was going to have this much value. Um, And the part I would somewhat disagree with is that we can imagine a world where Satoshi was as smart as he was, but he was like a scammer, right? So the Satoshi, as we understand him from his writings and his actions, is both intelligent and ethical and almost like professor-like. If you read the white paper, it's like an academic paper. He's not like a hype man. You can imagine someone who figures out all the pieces but then he pre-mines coins or he decides to start with gigantic blocks or starts with like tiny blocks that make no sense or um, basically he gets a variable wrong, like he gets 90% of the way there and then either does something ethically or technically it's bad enough that it doesn't really bootstrap, or it starts to bootstrap and stagnates, and someone says, hey, I fixed this one thing, and maybe it's the second or third cryptocurrency, and that's the one that actually takes off. Kind of like how Facebook eclipsed MySpace. Now, this was a pretty, people often talk about Bitcoin being eclipsed, but I mean, when you talk about, say, Facebook eclipsing MySpace, it happened in a very early period in their life cycle, right? At a pretty small level, right? So, especially in those first couple years, it's not that hard to imagine that it could have been not the first one that became the biggest, in my opinion. When the early variables are being figured out, when it wasn't clear that any of these were going to be valuable yet, right? I think there's that period where you could have eclipsed it, but I think that once you establish a network effect and you have reasonable variables and it's workable and decentralized, I think that's the point where you've essentially, you kind of hit escape velocity that it's very hard to have that be displaced, and then it becomes a better, more liquid, more hard money that's crowding out all of these kind of weaker attempts that either are not really decentralized or just will never get the liquidity, and things like that.
Fascinating. So Lyn, I want to take advantage of the fact that we got about roughly 14 minutes left. Is inflation necessary for a healthy economy? You asked this question, and holy cow, do people have very strong opinions about it?
Well, I would say no. I mean, I think if you rephrase that question is, does your currency have to be constantly diluted in order for economy to function properly? I think you'd get people would just be like, well, why? Why does it have to happen? I mean, if you look back at the 1800s in the United States, for example, you had a booming economy. I mean, that's where a lot of technological inventions were developed. You colonized the whole continent, and you were doing it with, a dollar, a gold-backed dollar, and gold-backed independent, banknotes and things like that. Essentially, the common unit of account was gold, and you had stable prices. They fluctuated sometimes up, sometimes down based on what was happening with supply and demand, and you had a lot of growth without inflation. Um, I think the only time where inflation becomes almost necessary is when it's already bad enough that that's the context that people think of it, right? So they go towards a fully fiat system that's inflationary. It builds up a ton of debt because that's what happens. If the currency dilutes, there's an incentive to take out leverage in that currency. You're essentially shorting that currency to buy other things. So you build up all this debt. If you then decide to be okay, we're going to be an ultra deflationary hard money system, well, all those debts are going to implode, right? And that's a process that has to go through if you're then converting from an inflationary system to a hard money system. So when economists say that things would implode without inflation, what they're really referring to is the current system. The current system, at this level of debt to GDP would implode in a harder money system. But it's something. It's kind of like ripping the band-aid off, or something like that, where if a better technology presents itself and solidifies and kind of asserts itself as inevitable, then it's meant to be. It's meant to happen.
And so, and who would be the losers if that band-aid did get ripped off, so to speak? And the argument, right, the Keynesian argument is you have to incentivize people to spend. What would be your response to that?
Well, so I think governments would be losers, especially ones that are just not in line with what people want. So I think war hawks, for example, people that always want to go to war and things like that would be kind of first in line to be, disenfranchised under that system. I think banks, obviously, like, right now, like asset managers, people that do leverage buyouts, basically think people that don't really build income streams, but that just either take existing income streams and lever them up, or people that just rent seek on the system without providing a lot of value. Basically, this overall layer of financialization would be much reduced in that environment. There still would be an importance of financial services, but that would just be a smaller percentage of global economy. Those would be the losers. What was the other question you asked? Oh,
I,
the Keynesian.
yeah, the Keynesian response would be you need inflation in order to incentivize people to spend in the economy.
Yeah, I mean, think it's well, one, it's obviously falsifiable with modern technology, right? So if that was the case, I would not have bought a TV for the past 20 years. I would just say I'm waiting for the day where TVs stop going down in price. But of course, if I want a TV now, I'm not, if I was like you know, 18 and I want a TV, I wouldn't wait till I'm 38 to get a TV, just because it's a deflationary asset. So I mean, people readily upgrade their phones. They readily buy new computers, even though these things, especially on a per quality basis, are getting cheaper over time. And that shows that, I mean, people have a time value of their expenses. They don't delay purchases indefinitely, just because that that purchase will be more effective in the future, because we do want it now, especially if it's important. We might delay. So I think in a harder money system, you would take out some of the more frivolous purchases. I think people would take money more seriously. Um, and so I think in some ways, in terms of the way they choose to measure GDP, it could be a little lower. But I think quality of life in many cases would be higher, right? I think it would reshape some purchases. Um, but I think the idea that you need to keep people on a constant treadmill of consumption by constantly diluting their savings, when you phrase it like that, it's madness, right? And so, obviously, I disagree with economists that would assert that. And instead, I would say that I do think people should ideally have access to ability to save money, and it's good to save, and that people know when they want to buy something, right? If there's a lot of things you just have to buy. You have to buy food, you have to buy shelter, you have to buy transportation, you have to buy clothes, you have to buy uh, you know electronic equipment, things like that to do your job. And then, everybody has to buy some entertainment some of the time. Some people are basically you're entertaining yourself somehow. And when people really want something, they get it. No one is like, short on things that they'd like to own. for the most part, and it just becomes, what do they prioritize? Um, and so I think the economists are kind of delusional when they think that people have to be incentivized with like, constant, just basically like a rat on a hamster wheel, um, to keep buying.
Yeah, and so, but why is it such like it's so green? It's so ingrained into the mainstream acceptable thought, right? Whether it's the main, I would call them legacy media, really the legacy mainstream media publications, whether it's populations, right? It's almost as if somehow they ended in this magical 2 to 3% number. Is it even possible to get the these ideas that we're discussing into the mainstream? Because I feel like it's so entrenched, or is it the type of thing where it's just going to happen because of the nature of Bitcoin?
Well, so the 2% number was arbitrary. It started in New Zealand, and then it spread from there. I mean, it's just an arbitrary number. Now, the funniest kind of like thought experiment that I've seen is that it's kind of indirectly based on gold. So if you look at gold over the past century, the estimated
Mm,
supply growth was 1.5% per year in a pretty tight band between 1 and 2% per year. There's a really good NIDIG chart that shows that that I've cited a number of times. And so 2% is kind of like this. It's almost like a gold proxy attempt. But what they miss is the fact that again, you're measuring from a negative number, right? Because productivity is generally positive over time, and so you know basically money supply growth is not the same as inflation growth. So the average fiat currency is inflating by, I think Safety's book cited 14% on a weighted average. If you look at the United States, it's been around 7% or 8% on average, decade out, over many decades. Many other developed countries are similar. When you get into emerging markets, developing countries, those are generally higher numbers. In the past 2 decades, the lowest has been Japan, something like 3% on average per year in terms of broad money. Um, and so a lot of that's just ingrained, but again, it's based on the current system. I think a lot of this is, we've had a century and a half, going back to my prior point, of commerce moving faster than money. And so there's this kind of structural period where all these norms get developed, and that's what we're used to. And once you build up very high debt levels based on that, how that system works, you know it becomes somewhat self-reinforcing, because if you don't have constant growth, constant inflation, those debt levels quickly become untenable, right? So it feeds on itself. And I think you'd have to have a clear vision of another system, and that system start to just assert itself whether people like it or not. Just the incentives are aligned. People that use that system get rewarded over time versus those that don't. And if that's a powerful and hard enough and unstoppable enough force, and it just kind of takes over, that eventually realigns what people thought. I mean, if you teleported yourself back to the 1800s and you said, and then if we're just going to take away our gold and we're just going to give you papers and you're going to trade that, and we're not even going to back those papers up with anything, right? Because you never, it's like back in the time you had to do it in steps. You had to say, okay, you have gold. Well, now if you put your gold in a bank and you get a bank note, you can always get your gold back, right? And then later you say, okay, now it's worth less gold, but it's still worth something. And then you say, okay, now it's not worth any gold. It's always in steps. And so the Overton window, or like the consumer, what they normally think about money, if they're not thinking about it very closely, changes based on what's happening at the time. And so I think over time you can go back, you can kind of it'll be like steps up. Like, it'll be weird to look back and be like, remember when there was like 180 currencies and most of them were like utterly terrible, and like they were just paper, and like we were all using like these like individual small like actively managed ledgers that were opaque, and like it's like things that seem normal now can go away and look funny in the future, but it's not something that snaps overnight. I mean, it's something that you get accustomed to over time, as it just becomes more commonplace, and only people that are kind of really thinking about it, or that in the industry, like either they're kind of forced to think about it, or they just their nature makes them think about these things more. They can maybe identify it and think of it as normal earlier, whereas other people just have to experience it and grow up in it, and just it just becomes normal.
Very interesting. So, Lynn, I want to take advantage of our last 4 minutes to ask you this. A lot of people had expectations for the last cycle. Bitcoin was meant to hit 100K. I think that there was a lot of variables that a lot of people missed. For example, the CCP banning Bitcoin mining literally in the run up, right? I think that took a lot of momentum out of it. The pressure by the miners to dump a lot of their coins to fund basically the relocation of the ASICs. Um, and then, I think the last cycle was 69 top. And then, this very famous, very predominant people expecting Bitcoin to hit. I think it's either $500,000 or $1 million by 2030. I don't want to get to into price speculation because that's not what we do on this channel. But what were your expectations last cycle? Why do you think we were let down? And what are your expectations moving forward? Are we witnessing diminishing returns? Is this what's happening to Bitcoin?
So my expectation changed a little bit over the course of the cycle. So if you read my June uh, 2020 piece, for example, I put 30 to 50K as kind of a base case. I tend to be kind of conservative, and so I was basically saying, look, prior cycles were huge. They've gotten a little smaller each time, um, and I think I even like cited the stock to flow, and I'm like, they're looking for this. But I wouldn't trust these numbers. I liked the charts back then. I liked the fact that you put the log chart and you do having cycles. Like when I first saw stock to flow ratio, I kind of immediately disregarded the number, but I actually found the visual helpful for understanding it. So I found it like a stepping stone to be like a insight, and I just discarded the number. And I had something like 30 to 50K as kind of my just baseline expectation. Once we got pretty high, I said, okay, well now the probability is higher. And when people were asking me in interviews, I said, I mean, I expect probably we're going to see 100K this cycle, and so Bitcoin ended up falling short of that. It was probably not my base case that we would say peak out at 69 and fall back into the teens. Um, I thought maybe we'd get up to like 100 something and then fall back to the I don't know the 40s, 50s. That probably would have been my base case. In the kind of the middle of 2021, for example. Um, I think a number of reasons. One is you had some degree of rehypothecation going on in the space. I think another part of it is just altcoin dilution. And that's actually the first risk I identified, is kind of what prevented me from investing for a number of years in the early days. Is I would say, well, why can't just anyone make more of these things? And who says that, you know, it's not going to be some very diluted thing? And eventually, when I saw the block size war and the resolution of that, and when I saw just kind of the network effects, and came to really understand the difference between Bitcoin and the rest of the space, I said, okay, no, this one is I think the winner. I think this is obviously the way to go. But I still think in every bull cycle, that altcoin dilution is a limiter in terms of how um, big Bitcoin can get, because everyone says, okay, well, I could put it in Bitcoin, but I can put it in this like little tiny coin that could go up 50x, and they all think they're going to get out at the top. Um, and so I did get concerned in 2021. There were periods where I started to predict something like 2013, where I thought like a double cycle, where I was like, when I saw like Dogecoin going vertical, when I saw like you know like Ethereum Classic was going vertical. There was like Cum Rocket, just like all these like the worst coins you can, just like bad coin, just going completely vertical in early 2021. I was kind of saying like, I would be surprised to see like a period of you know consolidation here to kind of burn some of this out before we can go higher. And so when we did experience that with the China ban, that's when my expectation was, okay, the next one will probably get us higher. And that's when we kind of, I think, stalled lower than I would have guessed. And I think a lot of that was just because during the rising PMI environment, which is when Bitcoin really has its opportunity to go up, it was diluted in terms of going into all these other malinvestments. And so I think that the way that Bitcoin can have a stronger cycle is, one would be a more significant breakdown of the dollar, right? So the dollar index stayed pretty strong in this cycle. Um, and the Fed's managing to tighten pretty significantly. If they get to a part later in the 2020s where they just kind of lose control of their currency in a way that emerging market does, that's where you could see Bitcoin have a much stronger cycle. And another one would be essentially that you just kind of run out of things to try in altcoin land, right? So each cycle kind of had a different theme.
Mm.
I think eventually you just kind of run out of new ways to, try new things, right? So there first it was like, oh, block size is different or block time's different, and then you had ICOs, and then you had DeFi and NFTs, and it's like eventually I think you kind of run out of rope in terms of all these kind of ways you can say, okay, we made a better Bitcoin, and eventually people are kind of like, well, we've gone through enough of these. I think Bitcoin's it, and I think you could get less and less dilution, but I think it's a process.
Yeah. Wow. Lyn, I really, really enjoyed that. Thank you so much for joining me on Simply Bitcoin IRL. Why don't you tell everybody where they can find you online and what you're working on these days?
Sure, I'm at lynalden.com, on Twitter at Lyn Alden Contact as well. I put out a lot of free content. I have a low cost research service as well. And the big thing I'm working on now on the side is a book. I'm trying to take some of my articles and essays, put them together with new content, and make a book. And it's not specifically a Bitcoin book. It's a book about money, that naturally in this day and age will have a significant Bitcoin component to it, but it also covers history of money. It covers central bank digital currency, stable coins, just basically the technological progression of money over time, and just my overall view of it.
I'd love to have you back on the show to talk about it. Lyn, thank you so much for joining us today, and see you on the next one, guys. By the way, the show continues. Going live with BTC sessions in about 5 minutes to do the news roundup. So see you guys there. Lyn, thank you so much for joining us.
Thank you.
Bye.
Good job.